Today, rocky roads, the DFA daily to the 8th of November 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the alternative and probably more realistic view of unemployment data just released in Australia. And we look at scams in Scam Awareness Week. We take a further look at RBA rate expectations as they try forward guidance after yield curve control was removed. And we look at why China won't save us this time should there be another global financial crisis. First, Australian unemployment increased to 9.2% in October, as over 12 million Australians were released from long lockdowns. The latest Roy Morgan employment estimates for October showed that unemployment increased 0.5 points to 9.2% and underemployment increased 0.6% to 8.6%. This means total unemployment and underemployment is 17.8%, which is very similar to that in August at 17.7% and July at 17.9% during the initial stages of the recent lockdowns in Sydney, Melbourne and Canberra. The increasing unemployment and underemployment nationally was driven by New South Wales and Victoria, both of which started the month in lockdown. Other states, including Queensland and South Australia, had increasing full-time employment in October, with both state premiers outlining plans to reopen their respective state borders in the lead up to Christmas. October was the month Australia finally started to emerge from months of lockdowns, they said, with Greater Sydney emerging from a 107-day lockdown on Monday the 11th of October, Canberra's 2-month lockdown ending on Friday the 15th of October, and Melbourne's 6th lockdown ended a week later on Friday the 22nd of October. And earlier that week, Hobart's second lockdown ended on Monday the 18th of October. So October was hopefully the last month we see widespread lockdowns around Australia, although there's always the chance a COVID-19 variant arises in the future that could cause renewed lockdowns. The end of the lockdowns has allowed the reopening of many businesses that have been forced to close because of heavy restrictions. Industries including hospitality, retail, stores, arts and recreation, and personal services such as hairdressers and personal training have been hardest hit by COVID-19 restrictions, and their reopening is set to drive a surge in employment during the next few months. This prediction is based upon the experience of Australia's employment market when Victoria exited its long second lockdown in October 2020. From November 2020 to July 21, full-time employment in Australia increased for a record 8 months in a row by 866,000 to a record high of 8,826,000. Although the increases in employment are unlikely to match the resurgence from a year ago, there is likely to be a strong rebound in the industries most heavily impacted by the COVID-19 lockdowns, as more than 12 million Australians who've been forced to remain at home for months are allowed to return to their normal lifestyles and spend some of the savings built up over the past few months. Just briefly before I move on, let me say I think the Roy Morgan approach to measuring unemployment is a much more realistic assessment and it aligns much more closely with our own analysis in our surveys. Now, from the 8th to the 12th of November, the ACCC ScamWatch service holds its annual Scams Awareness Week. This year's theme is Let's Talk Scams. Now, they want to encourage all Australians to talk to their friends and family about scams. So startling new research released by the Customer-Owned Banking Association, or COBA, which is one of the founding members of the Scams Awareness Network, for the Scams Awareness Week revealed that 8 in 10 people have experienced being approached by a cyber criminal in the past 2 years, and of those affected, a quarter did what was asked of them. The findings, based on an essential research poll of 1,094 people, investigated the incidence of scams that ask people to click on a link such as missing delivery, text messages, hand over personal information such as bank account or credit card details, or send money or goods. Our members and the broader banking sector have seen a significant increase in financial crimes targeting customers since the onset of the pandemic, said COBA CEO Michael Lawrence. This can have devastating consequences for ordinary Australians, eroding hard-earned savings and derailing financial plans. Scammers are becoming more sophisticated, creating believable scenarios that can be hard to detect. All age groups and demographics are susceptible. Higher levels of education did not reduce the likelihood of being a victim of a scam. Just as we can't have police on every street corner, not all scams can be stopped before you reach them. Everyone has a role to play in halting cyber criminals in their tracks. On the positive side, regardless of whether they were a victim, most of those who experienced a form of cybercrime are now more cautious when engaging with emails, texts and calls from unrecognised senders, with women the wariest. Now, they went on to say that customer-owned banks care deeply about the impact scams have on people in our community. And their top 5 tips to avoid falling victim to a scam are: first, if you receive a text message that contains a link, do not click on the link unless you're confident it is legitimate. Regularly install operating system updates and use antivirus software. Second, never provide any of your personal banking details to someone you don't know or trust, and never provide banking passcodes, including authentication codes, received via phone or email to anyone. Third, if you receive a suspicious request from someone who says they represent an organisation or government agency, call back using details you find in an independent search rather than the details they gave you. Fourth, be wary of unusual payment requests. Scammers will often ask you to use an unusual payment method, including preloaded debit cards, gift cards, iTunes cards, or virtual currencies such as Bitcoin. And fifth, anyone who's provided their banking details to a scammer should contact their bank or financial institution immediately. These are all very sensible measures, and I would endorse being cautious and careful in the current environment. Now, elsewhere, Mortgage Business says the Reserve Bank has insisted the cash rate will not increase next year, despite inflation creeping up faster than expected. In its quarterly statement on monetary policy released last Friday, the Reserve Bank of Australia has outlined an adjusted outlook for the cash rate. Data from the ABS recently showed the RBA's preferred measure of underlying annual inflation, the trimmed mean, which conveniently excludes extreme price rises and falls, has risen by 0.8% during the September quarter to be at 2.1% over the year. This placed inflation within the RBA's target range of 2 to 3%, a prerequisite it set for raising the cash rate, which wasn't expected to happen until 2024. The Reserve Bank acknowledged the inflation movement, stating it was higher than expected in the September quarter, but the RBA has forecast in its central scenario that wages growth will edge up to around 3%, while underlying inflation will only reach the middle of the 2 to 3% target band by the end of 2023. Trimmed mean inflation is expected to reach 2.25% by the end of next year and to reach around 2.5% by the end of 2023. Depending on the trajectory of the economy at the time, the board judges that this outcome could be consistent with the first increase in the cash rate being in 2024, the central bank wrote. But inflation could be shaped by consumer spending, which, if it turns out to be strong in a reopened economy, could support growth, and the unemployment rate falling below 4% in 2023, potentially pushing inflation a little above 3%. In contrast, a downside scenario, which could be invoked by a new virus strain or a decline in vaccine effectiveness, could eat away at spending and feed into unemployment surpassing 5% for the next few years, which would see inflation fall below the target range. While it did allow for a faster movement, the RBA has dismissed speculation that the cash rate could rise as soon as November next year. In some other plausible scenarios, wages growth and inflation could be higher than implied by the central scenario. If this were to eventuate, an increase in the cash rate in 2023 could be warranted, the statement said. However, in the board's view, the latest data and forecasts do not warrant an increase in the cash rate in 2022. The other prerequisite for raising the cash rate is wages growth, which the RBA has said will feed into rising inflation. But higher wages will require a tighter labour market. The board will not raise the cash rate until these criteria are met and is prepared to be patient, the statement said. But ANZ analysts have somewhat dismissed the RBA's thinking as outlined in the report. According to the head of Australian economics, David Plank, and others, the report from the ANZ stated that the forecast will be challenged in the near term which will see market pricing aggressively disagree with the RBA's stance. Whether or not the RBA remains patient will likely depend on wages growth, the research note stated. The economists believe inflation and wages outcomes will combine to trigger a hike in the first half of 2023. A move in the later part of 2022 is not out of the question, but would require a sharp acceleration in wages growth in the first half of 2022. We think this is too soon, they said. But I want to highlight something else, that with the yield curve control effectively being switched off, the RBA is now falling back on, quote, forward guidance. In other words, it's trying to tell people what to expect. And of course, there's really little to underpin it in terms of true data. So it's just opinion. And of course, opinion can change. So this is all very wobbly in my view, and I suspect rates will rise sooner than the RBA expects. And finally, Newsroom, which is an independent New Zealand-based news and current affairs site, included an interview with former Prime Minister Sir John Key, who says the ingredients for a very dark time in terms of a new global financial crisis are in place. And this time, China may not be the lifeline that it was in 2008 if growing debt levels and inflated asset prices turn out to be the harbinger of a new global financial crisis. Geopolitical tensions and Xi Jinping's focus inward means China may not be able to help New Zealand weather a potential global downturn in the same way the Asian superpower did in the last global financial crisis, former Prime Minister Sir John Key has warned. Speaking at the virtual launch of a New Zealand's initiative report on the risk of a new GFC, Key said growing debt levels, inflated asset prices, and geopolitical uncertainty presented the ingredients to what could be a very dark time in our economic future, if we're not careful or lucky. Balance sheets appear to have weakened in the last decade as central banks pumped up the money supply enormously and governments borrowed heavily, while recessions are getting bigger, more severe, and much more connected. He did not agree with the view that the debt levels of governments were unimportant, saying not every country was treated equally when it came to the terms of such lending. We are a little country at the bottom of the world. We always paid a high price and risk premium for the debt we can borrow. The higher those debt to GDP levels, the more exposed you become, and in a GFC, they'll show up to be even more. While some argue that countries could agree to write off government debt, history shows that much of that debt is often held by the private sector, which would not necessarily be inclined to take the hit. Private sector debt was also extraordinarily high, while research from NZ Bank, Key is the chairman of its New Zealand board, has shown that roughly 40% of Australians and New Zealanders have gone into the pandemic with less than $5,000 of savings in the bank. If you take New Zealand and you look at inflation and look at that globally, and you make the case, as now Reserve Bank Governor Edwin Orr is, that interest rates will have to go up, it doesn't take too much to realise how much pressure that's going to put on households already. While he did not believe New Zealand's housing market would collapse, he believed the boom run is over for a period of time, with the high prices at present not sustainable. Interest rates were starting to track upwards, while the Reserve Bank was deploying tools like debt-to-income ratios, and migration levels were much lower than previously. Key said geopolitical tensions were also an important factor in potential financial instability, with friction in the US-China relationship having endured through the transition from Donald Trump to Joe Biden. And while China had served as the third leg of the stool during the last global financial crisis, with the country's economic growth and capacity to buy goods and services helping to prop up other nations, it was not clear it could fill the same role today, due both to some countries' unwillingness to engage with the superpower and Xi Jinping's push for common prosperity through self-sufficiency. Xi's shift in economic policy had created two main victims to date, including the country's real estate sector, as fears continue to grow about the fate of heavily indebted Chinese property developer Evergrande. Evergrande is very large and its debt levels are huge, hundreds of billions of dollars, but it's only one of many, and the question is, would the government be happy, for instance, to see some collapses in that area? Because maybe part of that would see real estate prices come down, and that's been one of their real concerns, that real estate prices are moving ever increasingly out of the reach of low to middle income Chinese nationals. The technology sector could also be under threat, with the Chinese government having effectively halved the value of large companies like Alibaba, Tencent and WeChat through public comments and actions. Now maybe they consider that much of that stock or whatever is owned offshore, and so they're less worried about it. But it is an important part of their economic story that they built a smart China, and so actually a high-functioning tech sector has been really important. The New Zealand Initiative report, co-authored by Bryce Wilkinson and Leonard Hong, warned that the United States, European Union, United Kingdom and Japan, among others, seem to be walking the path to the next global financial crisis. The coexistence of a major recession in 2020 with record high share market indices, record gains in US household net worth and falling bankruptcies is bizarre and unnerving. Major central banks had lowered their interest rates and purchased assets to unprecedented degrees through quantitative easing, with large government deficits and extreme peacetime public debt ratios now the norm. The current risks were in part due to the response to the last global financial crisis, with the bailing out of financial institutions and the expansion of lending, while understandable weakening market discipline and pumping up public debt ratios. Artificially low interest rates were encouraging people to borrow to buy risky assets at inflated prices, while sustaining so-called zombie firms or heavily indebted companies with no future. The worst-case scenario include plummeting asset prices, followed by financial panic and bankruptcies and unemployment at a large scale. While there was a more optimistic outcome based on strong and sustained economic growth and the use of rising government revenue to reduce deficits, the report said that required, quote, wishful thinking. Small economies like New Zealand needed to take prudent defensive measures, restoring net debt to appropriate levels before the next crisis and reviewing the composition and avoiding, where possible, commitments that would permanently increase spending. Wilkinson said that the system's fragility meant that there were a great many things that can tip it over, including US-China tensions or defaults in the Chinese property market. And he described the Chinese economy as a potential black swan, saying the country's lack of transparency made it difficult to gauge the scale of the problem with its high debt levels. China's a bit of a dark horse, absolutely a totalitarian sort of government, so it will do whatever it can to bury the things it doesn't want the world to see, of which economic stress would be one. Very well put, actually. And I do think it's important we understand that the risks in the system are extreme at the moment. And actually, the more central banks go on pumping and the more private debt continues to grow, the greater the risks are. At some point, it will come home to roost. But in the meantime, we're on the rocky road. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.